Hi everyone, it's Grace. Welcome back to my channel. So far, we've seen some very interesting movement in the market, and let's just take a look at the market movement at this time. In the last video, I discussed why I think a lot of people quitting is actually a sign of economic boom instead of a bust, and what the Fed intended to do over its conference. You can click here to check out that video. Today, I want to share with you my observations for the past few weeks regarding what's happening in the COVID policy, the Fed rate hike schedule, and its attitude to the increasing inflation rate. Before we begin, remember to subscribe to my channel and click on the bell button so you get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. My first observation is that the COVID cases are going down, and it seems like it's becoming more and more like the regular flu with a lower mortality rate. So are we expecting a relief in a supply chain shortage? I think that's a possibility. There have been several peaks of COVID cases, each of which is predated by a development of a new variant. I remember a very important correlation between the level of contagion and mortality rate. Usually, the less contagious, the higher the mortality rate, and the more contagious, the lower the mortality rate. Omicron is the most contagious variant among all variants so far. That said, I don't think Omicron is going to be the last variant, but it's becoming less deadly. This is extremely important. For the past year or so, I've discussed a lot about COVID and government policies regarding lockdowns, federal moratorium, stimulus, in a sense of stimulus package and not quantitative easing, and other things that are used to address the economic issues caused by COVID. A lot of them are public policies that to some degree intervene with the free market. And I think one useful way to see whether these public policies are welcomed or not is by comparing the situation between China and the US. China has a rather draconian policy called the zero COVID policy. It has been effective for sure when it comes to controlling COVID cases, but the whole economy collapsed last year. For example, we saw the downturn of the entire property development sector, including giants like Evergrande, Shimao, Kaisa, and the list goes on. What confuses me the most is that the government is decreasing the loan prime rate to increase lending activities in the market. But at the same time, it's asking people to report any transactions above $8,000 in any financial institution. So I'm like, is this really helping the economy to recover, or is it making everything worse? Anyhow, I think it's sending a lot of contradictory market signals, and it's impossible to form a pattern of the market movement. I can say that the intervention of Chinese public policy is abrupt, stringent, and too much of a roller coaster ride, which is really not what an economy needs. I think China's current situation is a good reference point of what the Fed needs to do to stabilize the market in the US. If COVID is becoming more like a regular flu, public interventions such as lockdowns, mandates, or whatever that disrupt the market might not be welcomed. So I think the supply chain shortage might be relieved gradually. And this might be a sign for soft landing. The second observation is that there has been a lot of discussions for the past few days of whether the Fed will raise 25 or 50 base points or even more, and if those rate hikes are more frequent. I find it useful to look at the historical data when it comes to this. The Fed rate hike after the 1990s Gulf War recession is more cautious and planned, unlike the periods before where rate hikes are sharp and sudden. This is also shown in the larger gaps between recessions after 1990s compared to before. As you can see, recessions hit more frequently before the 1990s than after. I mean, don't get me wrong, rate hikes will still lead to a recession, but the economic expansions are much longer. I also notice a pattern of rate hike and rate decrease. The rate hikes after the 1990s are typically more moderate, mostly with 25 base points at a time, with more frequencies, while a rate decrease is more progressive. It can be as high as 75 base points, but mostly 50 base points with less frequencies. And the third observation is regarding the inflation rate represented by the CPI in January, which just came out to be 7.5%. I want to be more precise about what parts of the inflation rate influence what parts of the market, but in today's video, I'm just putting some general forecast. I'll discuss how the inflation rate affects our lives in another video. In general, I don't think the CPI table is very useful in showing how serious inflation is. Of course, for people with lower income, almost everything becomes more and more unaffordable. Some items such as food, utilities, and rent are just basic needs that people just can't live without. Even though things are becoming more expensive, the demand is not reducing, and people will adjust their family budget accordingly, meaning that they will switch to another company or service to maintain the same budget if necessary. Energy, cars, and other items have greater influence on producers than consumers. So I think the CPI is only one dimension of inflation. Depending on the merchandise you're referring to, inflation can be either better or worse than the CPI indicator. One less interesting observation is that when the CPI in January just came out worse than expected, I almost feel that there's a sense of pressure from the media to urge the Fed to increase rate more aggressively, as if increasing rate will immediately tame the inflation without any consequences, but that's not the case at all. The effect on inflation is almost always delayed, and any abrupt, larger increments of rate increase will wipe out a good portion of the equity built in a certain asset type. I'm not saying inflation is not bad, because clearly it has affected certain aspects and some population. But I think that as a consumer and investor, if you want to understand how the Fed implements the rate hike and how the policy affects all kinds of asset markets, looking at past data and remaining a sense of reason is more reliable. So I think the Fed will probably follow the rate hike pattern after 1990s, and a 50 base point hike is unlikely. If anything, I think more frequent rate hikes of 25 base point is more likely than less frequent rate hikes of 50 base points. That said, the rate hikes may be implemented across a number of years instead of concentrated in this year only, and that could be a sign for soft landing. When I talk about soft landing, what I mean is that the Fed's action is more planned, organized, and predictable. Each rate hike, the cost of lending for individuals and companies can be measured, and investors can plan and transfer from one asset to another according to the pace of the Fed. So you won't be caught off guard and lose everything all at once. So we'll see what happens on Monday, whether the Fed will have an emergency Valentine's Day meeting to increase rate or wait until March to do so. And if it happens, I think a 25 base point is more likely. At any rate, a soft landing is better than an abrupt recession, and monitoring the money flow from one asset to another is more helpful. So this is today's video why I think this year might be a start to a soft landing. What do you think? Let me know in the comment section down below. As always, thank you very much for watching, and I'll see you on the next one.